You'd think the market would destroy beginners first. People with no knowledge, no strategy, no experience. But that's not what actually happens. In reality, the market has a much darker sense of humor. It feeds on smart people, engineers, analysts, doctors, programmers, people who can explain exactly why a trade should work, right before it wipes out their account. And here's the uncomfortable truth no one wants to admit. Intelligence is often the trap, because the smarter you are, the easier it is to convince yourself you're right. You don't guess, you justify. You don't gamble, you calculate. And when the market moves against you, you don't exit, you explain. That's the moment the market turns a smart trader into what it loves most, a confident loser. Not because you lack knowledge, but because your mind is working against you. In this video, we're going to expose the psychological trap that quietly turns intelligent traders and investors into easy prey. Stay with me, because once you see it, you'll never trade the same way again. Part 1. The dangerous illusion. I'm smarter than the market. Here's where the real trap begins. Not with greed, not with fear, but with something far more subtle. Confidence built on intelligence. When you're smart, educated, analytical, you don't feel like you're gambling. You feel like you're figuring things out. You read books. You understand macro. You know fundamentals, technicals, sentiment. You can explain why price should go up or down. And slowly, without realizing it, a dangerous belief forms. If I understand the market deeply enough, I can stay one step ahead of it. This is the illusion. Because the market does not reward understanding. It rewards alignment with probability. Why smart people fall into this trap faster. Beginners are afraid. They know they don't know. Smart people, they trust their thinking, and that's the problem. Intelligence creates a feeling of control. Control creates certainty. Certainty kills respect for randomness. You stop asking, what if I'm wrong? And start thinking, the market just hasn't realized I'm right yet. The moment intelligence turns into blindness, let's say you buy a stock. You have reasons: strong earnings, good valuation, clear technical support, price drops. A beginner panics, but the smart trader does something worse. He thinks, this drop doesn't make sense. Institutions are manipulating. This is just noise. My thesis is still valid. And just like that, the trade is no longer about risk. It's about being correct. You're no longer managing a position. You're defending an idea. The market doesn't care about your logic. Here's a brutal truth. The market can stay irrational longer than you can stay solvent. The market doesn't move to confirm your analysis. It moves based on liquidity, positioning, fear, and greed, forces you cannot see or measure in real time. Your analysis might be logical, but logic doesn't pay bills. Example, the brilliant losing trader. I've seen this hundreds of times. A highly intelligent trader explains a losing position perfectly. This level is historically important. This move is statistically stretched. Fundamentals don't justify this price. Everything makes sense, except one thing. The account keeps bleeding. And when you ask why they didn't exit earlier, the answer is almost always, because it shouldn't be happening. That sentence has destroyed more accounts than bad entries ever did. Why this illusion is so seductive? Because being smart has worked everywhere else in life. In school, thinking harder helps. In your career, analysis brings results. In business, planning creates advantage. So you assume trading works the same way. It doesn't. The market is not a problem to solve. It's a system to survive. The quiet shift that ruins everything. At some point, smart traders stop trading price. They start trading their opinions. They add to losers because value improved. They hold too long because the story isn't over. They ignore exits because the setup is still valid. And without noticing, they cross a line from risk manager to intellectual gambler. The uncomfortable realization. The market doesn't punish stupidity first. It punishes certainty. And intelligence is often the fastest path to certainty. That's why some of the most intelligent people become the market's favorite victims. Not because they lack skill, but because they trust their mind more than they respect uncertainty. Part 2. The overthinking trap. When analysis becomes self-sabotage. This is where smart traders really get stuck. They don't lose because they don't analyze. They lose because they analyze too much, and for the wrong reason. At first, analysis is a tool. Later, it becomes a shield for the ego. When analysis stops serving decisions. In the beginning, analysis is meant to answer one simple question. Is this trade worth the risk? But slowly, the question changes into something dangerous. How can I prove this trade is right? That's the moment analysis turns toxic. You're no longer trying to see the market clearly. You're trying to protect a position you already took. The illusion of safety through complexity. Smart traders love complexity. More indicators, more confirmations, more time frames, more data. It feels safer because complexity creates the illusion of precision. But precision is not certainty, and more information does not mean better decisions. In fact, it often does the opposite. The more variables you add, the easier it becomes to. Find something that agrees with you. Ignore what contradicts you. A simple example everyone recognizes. Imagine this. You enter a trade. Price goes slightly against you. Instead of asking, is my risk still acceptable? You open another chart, then another time frame, then another indicator. RSI says oversold. MACD shows divergence. Volume looks interesting. Suddenly, you feel calmer, not because the trade improved, but because your brain found reasons to stay. That calm is fake. It's not confidence. It's self-deception. Why smart people overthink more than beginners. Beginners don't have enough tools to overthink. Smart traders do. They can justify almost anything. They know. Market narratives, historical analogies, statistical exceptions. So when price sends a clear message, they respond with a lecture. Price says, you're wrong. They say, let me explain why I'm early. And early is just a polite word for wrong with confidence. Analysis as emotional anesthesia. Overthinking has one hidden function. It numbs emotional pain. Cutting a loss hurts. Admitting you're wrong hurts. But analyzing more? That feels productive. That feels intelligent. That feels safe. So instead of acting, you think, and the market keeps moving. The silent damage over time. Overthinking rarely kills accounts instantly. It kills them slowly. Small losses turn into medium losses. Medium losses turn into long-term positions. Stops are moved. Risk quietly expands. And when the damage is obvious, the trader says, I didn't expect this scenario. No one ever does. Because overthinking convinces you that you've already considered everything. The paradox smart traders hate to hear. The best traders are not the best analysts. They are the best decision makers under uncertainty. They analyze enough to define risk. Then they stop thinking and let the system work. Smart traders do the opposite. They enter first, then think forever. The real question analysis should answer, not why this trade should work, but at what point am I undeniably wrong? If your analysis can't answer that clearly, it's not analysis, it's storytelling. This is the overthinking trap. Where intelligence doesn't fail, it turns inward and attacks its owner. Part 3. The intellectual ego trap. When being right matters more than making money. This trap is quiet, invisible, and extremely destructive because it doesn't feel like ego. It feels like self-respect. How the ego hides behind intelligence. Most traders imagine ego as arrogance, loud confidence, big talk. That's not the dangerous kind. The dangerous ego sounds reasonable, calm, intelligent. It says things like, I've done my homework. I don't panic like amateurs. I trust my process. But underneath those words is a fragile belief. If I'm wrong, it means I'm not as smart as I think. And that belief is poison. Why smart people struggle to admit mistakes. In most areas of life, intelligence is tied to identity. You're praised for being right, having good arguments, seeing what others miss. So when trading challenges your ideas, it doesn't feel like feedback. It feels like a personal attack. The market isn't just saying, this trade didn't work. It feels like it's saying, you're not as smart as you think. And the ego cannot accept that easily. The moment trading becomes a debate. Here's where things go wrong. Instead of reacting to price, the trader starts arguing with it. Price goes against you, you explain why it's temporary. Price breaks your level. You redraw the level. The stop is hit. You say the stop was too obvious. The market is not a courtroom. It doesn't care about your arguments. But once ego is involved, trading becomes a debate you refuse to lose. A very common example. A trader enters a position with a clear stop. Price approaches the stop. Instead of executing it, the mind says, let me give it a little room. This move is emotional. Big players are hunting stops. The stop is moved. Not because the setup changed, but because losing would hurt the ego. And just like that, discipline collapses. Why this trap creates the worst losses. Ego-driven losses are different. They are not fast. They are not dramatic. They are stubborn. The trader holds because selling would admit failure, because exiting would confirm doubt, because being wrong feels worse than losing money. So the position stays open. Loss grows. Stress increases. And eventually, the market forces the exit at the worst possible moment. The illusion of strong conviction. Smart traders love the word conviction, but there's a difference between conviction based on a system, conviction based on ego. System-based conviction has rules. Ego-based conviction has excuses. One exits when conditions break. The other exits only when pain becomes unbearable. The brutal truth. The market does not reward intelligence. It does not respect confidence. And it does not care about your self-image. It rewards one thing, the ability to be wrong quickly. And that ability requires something deeply uncomfortable for smart people. Humility. The shift that changes everything. The moment trading stops being about you and starts being about process, the ego loses its grip. Because now, losing a trade doesn't mean, I failed. It means one outcome played out in a probability game. That mindset is freedom. This is the intellectual ego trap, where smart people don't lose because they lack skill. They lose because they refuse to detach their identity from their opinions. The way out. Escaping the psychological trap. This is where everything changes. Not with a new strategy, not with better indicators, not with more knowledge, but with a shift in how you relate to the market. Step 1. Stop asking the wrong question. Most smart traders ask, am I right? That question is poison. Replace it with, if I'm wrong, how much will I lose? This single shift moves you from ego, risk, prediction, survival, opinion arrow process. The market doesn't need your certainty. It needs your respect. Step 2. Separate identity from outcome. This is non-negotiable. A losing trade is not a failure. A sign you're stupid. Proof you don't get it. It's just one outcome in a probability distribution. Professionals don't feel proud when they win. They don't feel ashamed when they lose. They feel nothing. Because emotion clouds execution. Step 3. Design systems that protect you from yourself. Assume this. You will hesitate. You will rationalize. You will want to break rules. So don't rely on willpower. Rely on structure. Predefined risk. Predefined exits. Position sizing that prevents damage. Rules that trigger action without debate. Discipline is not personality. It's architecture. Step 4. Embrace being boringly consistent. Smart traders want stimulation. Markets don't care. Real profitability is repetitive, same setups, same risks, same behavior. If trading feels exciting, something is wrong. Excitement is usually a sign of oversizing, overthinking, overconfidence. Step 5. Respect uncertainty as a permanent condition. You will never know enough. The moment you think you do, you're vulnerable. Professionals don't try to eliminate uncertainty. They build around it. They accept random outcomes, long losing streaks, imperfect information, and they keep executing anyway. The final mental shift from, I trade to prove I'm smart, to, I trade to survive long enough for my edge to work. That shift is everything. The quiet power of humility. Humility in trading doesn't mean thinking less of yourself. It means thinking less about yourself. When the trade is no longer about you, clarity returns. This is the way out of the trap. Not by becoming smarter, but by becoming less attached.